Good afternoon, everybody. On behalf of Motilal Oswal Securities, I welcome you to JSW Steel conference call. We are delighted to host the management for discussion on the first quarter results and the business outlook. After opening remarks from the management, there will be a Q&A session. Now I hand over the call to Mr. Pritesh Vinay, Vice President, Corporate Finance and Group Investor Relations. Pritesh.
Thank you, Sanjay. A very good evening to all the participants. On behalf of JSW Steel, we welcome you to the first quarter fiscal 2019 results earnings call. I'm sure you have had a chance to go through the results, the press release and the presentation, which has already been uploaded on the website. We have with us today the management team of JSW Steel, represented by Dr. Vinod Nowal, the Deputy Managing Director, Mr. Jayant Acharya, Director Commercial and Marketing, and Mr. Rajeev Pai, the CFO. I'll hand over the floor to Mr. Acharya for opening remarks, and post that we can move to the Q&A.
Yeah, so good morning, everybody. So the last quarter, I think we have seen a positive global outlook. IMF reaffirmed its growth at 3.9% for the year, although they have outlined that the growth may be more uneven and there could be risks because of trade tension. This has translated into better growth prospects. Basically what we have seen in US, the activity in Europe has also so far been positive. We are seeing the buoyancy in the economy translating into a better steel demand. And global steel demand, if you recall, in the last quarter, we had presented that World Steel Association predicted that the steel demand would grow by 1.8%, in which China demand was expected to be flat. In the first half of this year, the Chinese demand has gone up substantially. It has shown a growth of 8%. And India in this last two quarters, the quarter 4 of last year and quarter 1 of this year, has grown by about 8.7%. So if you look at these two numbers, basically doing much better than the earlier expectations, we see a positive upside to the world's demand growth in this year. If you look at India, I think Indian economy is doing well. We are seeing the spend of the government in various infrastructure projects picking up. We are seeing gross fixed capital formation improving. We are seeing a strong consumer demand. The automotive, the vehicle production is doing well. Appliances production and demand both have gone up. On the rural demand side as well, I think we are seeing a positive growth. A good monsoon should further improve the rural demand in H2. Having said that, I think the general positive growth momentum in the world and stable raw material price has kept the steel prices in a range-bound kind of a range in this quarter, last quarter. In India, we do expect that inflationary pressures to pick up. We are seeing oil prices going up, the depreciation of the rupee having an impact. Liquidity conditions have become tight, and due to which there could be an impact on the rate cycle as we go along. So these are areas which we need to watch. The steel side, I think in India, what we have seen is that while the demand in the quarter, last quarter, has been good at 9.2%, and the production has gone up by 6.2%. But in the last quarter, India has become a net importer. We have seen a 15% increase in steel imports into India, and YOY, and quarter on quarter, the imports have gone up by 31%. Exports in the last quarter have moderated by 16% to 1.85 million. And when we look at the exports from China, Japan, and Korea to US, that has dropped by about 240,000 tons. And in the last quarter, during the same period, we see a pickup in imports into India from China, Japan, and Korea by almost 460,000 tons. So there is a linkage to the trade barriers which are being put up in U.S. and diversion of that steel coming into India, which is a cause of concern. So while the Indian demand has been positive, we need to be watchful of the trade diversions which could take place into India, and therefore effective trade measures will have to be looked at. Having said that, I think the steel results from JSW Steel has been very good for the quarter. We have produced 4.11 million tons of crude steel, which is up by 5% YOY. Saleable steel sales for the standalone was at 3.83 million tons, which is up by 9%. And revenues from operations at 18,964 is up by 23%. The operating EBITDA at 4,822 crores is up by 119%. And the highest ever quarterly net profit at 2,338 crores for standalone. On a consolidated basis, the saleable steel sales went up by 11% to 3.76 million tons. The revenue from operations rose to 20,519 crores, which is up by 25%. The operating EBITDA at 5,105 crores is up by 95%. And net profit after tax at 2,339 crores was up by 275%. If you look at the growth numbers of 11% on a consolidated basis, the ratio of sale domestic to exports was 88% domestic and 12% export. Our sales in the domestic market went up by 27%. Our value-added and special products sales grew by 6% YOY and accounted for 55% of the overall sales. Sales to automotive went up by 57%, while the automotive production grew by 17%. Our numbers in terms of automotive sales have been very positive. Our sales to appliances have grown by more than 100% YOY. So we are seeing a strong consumer demand playing out in the consumer durable and the automotive space. On the subsidiaries performance, I think JSW coated products during the year have registered a production of 0.43 million and a sale of 0.43 million tons. The operating EBITDA has been at 122 crores for the quarter. Net profit stood at 42 crores. The U.S. plate and pipe mill has improved the capacity utilization, and it produced 80,777 net tons of plates and 14,021 net tons of pipes, reporting a capacity utilization of 35% and 10% for the pipe mill. The EBITDA at 10.69 million has seen a substantial improvement over the last quarters. On a consolidated basis, we have already given you the numbers. The other positive is that the net gearing, the net debt to equity at a consolidated level has improved very much to 1.32 at the end of the quarter as against 1.38 at the end of quarter 4. And net debt to EBITDA at a console level stands at 2.26 as against 2.57 at the end of last quarter. The company's debt is also at a manageable level of 39,090 crores. The net debt increased by 1,070 crores primarily because of depreciation of the rupee, which accounted for 865 crores out of this 1,070 crores increase in debt. On our acquisition side, the resolution for plan submitted for Monnet Ispat and Energy has been approved with modifications by the Mumbai bench of the NCLT, and the written order is awaited. The acquisition of FRP in Italy, erstwhile Lucchini, has been completed, and now we have the shares, 100% of the shares transferred to us for FRP and Piomino Logistics, and 69.27% shares for GSI Lucchini. On Acero Holding Junctions, we have already completed the acquisition of 100% shareholding in Acero Junction, Ohio. and the work of starting the electric arc furnace has commenced, and we expect to start the operations by October. In Italy, we have a 1.3 million ton rolling facility, and we expect the rolling mills to start in phases in the next quarter. On the projects and CapEx update, I think all the key projects are on track, and in Dolvi and the expansion of capacity at Vijayanagar, including the ramp-up of CRM complex and the modernization and enhancement of capacity at our JSW Steel Coated. Our outlook continues to be constructive for the coming year. We see a stable economic growth, except for one-off events which may come. We do not see a slow growth potential this year. The concern on trade tensions emanating out of U.S. and consequently retaliatory measures by others needs to be watched. Chinese production is strong. While Chinese exports have gone up in the month of May, we are watching the export trend as we go forward. But the good thing is that China's domestic demand has been quite stable and has been positive. So with this, we will leave the questions open.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Sumangal Nevatia from Macquarie. Please go ahead.
Yeah, good evening, and thanks. Congratulations on the strong quarter. First question is with respect to iron ore cost. The presentation says it's up almost 14% YOY. Some part, I believe, is due to change in sourcing mix. And we also read about some disputes between us and NMDC. Is it possible to elaborate what exactly is the issue and our stand? And the second part of the same question would be the pipe conveyor at Vijayanagar is about to commission in the next 2-3 months. So how will cost and sourcing change for Karnataka requirement?
So our iron ore cost on a quarterly basis has moved up. Yes, that is correct. But on a QOQ basis, we'll give the flavor of the detail to you. But it has not moved up to the extent of 14%. 14% you may be saying with respect to YOY.
Yeah, YOY. That's right.
On the purchase sourcing of iron ore, I do not think that we have per se any issue. We are purchasing from NMDC as well. In addition to that, we are importing iron ore from outside, which have a better productive utilization in terms of value and use. The alumina levels and the slag levels, therefore are in control. Therefore, the value and use is better. We have also taken some higher grades from Orissa to balance the lower grades in Karnataka, and that is basically to reduce the cost of fuel, because when the coal prices go up, the fuel cost essentially also goes up. So if you're using better iron ore quality and the blend is better, then the cost of fuel also is better in control. As far as the pipe conveyor is concerned, I'll request Dr. Naval will give you some more details on that.
This pipe conveyor work is in advanced stage, and we are very much hopeful by September or maximum October we will commission movement of the iron ore through the pipe conveyor. And assume today our cost of freight cost is around 450 rupees to 500 rupees per ton. That is going to be through pipe conveyor less than 100 rupees.
How much volume do we plan to, what mix from Karnataka domestic, within the state and from Odisha or imports?
Like Supreme Court has allowed to do the mining in Karnataka, 35 million. But so far it looks like that in Karnataka it's going to be around 29 to 30 million only this year. So our requirement is around 3 to 4 million, which we have to source from out of the Karnataka. Once it's the level of the 35 million, then definitely we will take the call.
Understand. Second question is with respect to NSR. In this quarter, it's up almost 3,500 QOQ. So just wanted to understand, is there anything specific to JSW contract in these NSR, or it's a broad representation of the industry prices in the quarter? And the second part is the prices are coming off, but of course we've exited the quarter on a high base. So if you could just share how is July prices versus 1Q average?
Yeah, so on the NSR, NSR has gone up in line with the prices internationally. So if you were to compare April-June of last year to April-June now, international prices have moved up and Indian prices have also moved up, though probably at a lesser pace than what the international prices have. The second thing which came in the quarter was the quarterly prices, which were readjusted in April-June. We also had a better mix of automotive and appliances, and we had a better domestic mix as well. So therefore, the positive on the price increase, the blend with respect to the automotive, appliances, value-added and specials, giving you additional benefit. The prices going forward, I think in this month of July, seasonally we do expect some kind of moderation, especially in the long product side, which has already happened in the secondary market, where because of lack of activity in construction, there is some moderation of prices in rebars which take place. But it has happened so far in rebar and structurals in which we are not present. But rebar, some moderation has taken place in July. As far as flat steel is concerned, the prices have been by and large stable. And we think the prices will be moving in a range-bound manner. We do not see any kind of sharp deviation in the prices. It would be range-bound.
Understand. Thanks and all the best.
Thank you. We take the next question from the line of Indrajit Agarwal from Goldman Sachs. Please go ahead.
Thank you for the opportunity, sir, and congratulations on a strong set of numbers. So my first question is on the sales volume. Your consolidated sales volume is lower than standalone. Can you throw some light on that, if it is our domestic coated product business that we have higher inventory?
Yeah, so there were two reasons if you were to compare on a YOY basis. One is that in the coated, there was an impact of inventory increase, which took place in this quarter. The other one was that last quarter we had a little bit of the conversion from Uttam as well, which was there, which in this quarter has not been there. Coated has lagged behind a little, one because of the imports which went up sharply. We had pointed this out in last quarter as well. And in this quarter also, the coated imports into the country continue to be a matter of concern. And the other one is a lead lag impact between the price increase on hot rolled versus the price increase playing out in the coated products, which takes typically always a little time to follow.
Sure, understood.
Some inventory build up. The major loss in coated in terms of volume has been while some quantity in exports, but we have also moderated, some quantity in domestic, but we have also moderated our exports.
Sure, that makes sense. Thank you so much. Second question is on overseas acquisitions. In some news flows, it has been mentioned that our target is 10 million ton. So is it just downstream or a combination of downstream downstream and upstream?
No, it's when we are talking about the steel making facilities, crude steel production, we are looking between 8 to 10 million tons. Our idea is that in U.S., where we have recently acquired the facility in Ohio, we would be investing into that to start the first electric arc furnace and get that operational, which would be about 1.5 million tons. The caster and the hot strip mill is already 3 million tons. The second electric arc furnace, the 1.5 million ton, we will take up in phase 2. So this will be a 3 million ton integrated facility in Ohio. In addition to that, we have already announced, as you are aware, the Baytown expansion, backward integration of 1 million tons to make 1 million integrated facility for plate and pipe. So we would have a 4 million ton kind of a possibility in U.S. In addition to that, we have looked at the acquisition at Italy. We currently have 1.3 million tons of rolling mills in Lucchini at Piombino. In phase 1, we would be operating the rolling mills, which will be rail bars and wire rods. In phase 2, we are looking at the option of setting up a hot strip mill of a 3 million tons. So the total capacity in Lucchini could be up to 4 million tons of this thing, which would be the 3 million tons of facility would be looked at only after due consideration to the supply, demand, and the environment and other factors which we will need to study. So these two facilities put together will account for about 8 million. International acquisitions, in case there is any which come up, we would look at it as long as it makes economic sense. So therefore, the range of 8 to 10 million is this from crude steel point of view.
Sure, thanks a lot. And if I can squeeze in one more, can you tell me how is the capex spend for this quarter?
2,000 crores in this quarter.
All right. Thank you, sir. That's all from my side.
Thank you. We take the next question from the line of Anuj Singla from Bank of America. Please go.
Yeah, thank you very much for the opportunity, sir. So first question relates to the new accounting standard in the AS 115. As per my understanding of whatever has been given in the press release, it should be EBITDA neutral. However, for the fourth quarter of FY18, for the March quarter, EBITDA tends to rise by around 360 crores on the standalone. Sir, can you just help me, give some color on that?
Last year, quarter 4, we had certain incentives which were accrued in the quarter 4, and that is the result you are seeing that increase in quarter 4.
Sir, so this is, but these incentives are pertaining to GST, which has been mentioned in the press release, or is it some notification which has come out recently, which was not there in quarter 4? Is that what it relates to?
The incentives which were accruing earlier as per the prior approval, the GST has announced an incentive as per the SGST rates. And on filing the relevant claims, we have decided to accrue those incentives in our financial.
Okay. And sir, going forward, it's fair to, so is there a quarterly run rate? What kind of incentive should we be expecting? Is there a, maybe in percentage terms or something, just to get a broad idea? What kind of incentive we should be expecting in the coming year?
Excepting what was taken as one-off item in quarter 4, our current quarter is more or less a regular run rate which will be continuing.
Okay, understood, sir. And secondly, sir, like Mr. Acharya mentioned, the flat prices are more or less stable, while we have seen some weakness in the long product prices. However, we have also seen a significant weakness in the coking coal prices. So will it be fair to assume that given the exit run rate, what we have seen for the realizations for the last quarter and the declining raw material cost, we could see this kind of profitability continuing in this quarter? Is that a fair assessment?
I think it will be difficult to say some kind of a guidance on the profitability, but I think what from the coal side, what you raised is that while the coal prices on FOB basis have gone down to some extent over the last quarter, but the result of that will probably play out in the next quarter, because 60 days of stock either in transit or in port or in plant is always there. So July, September, we expect our coking coal prices to be by and large flattish with respect to what it was last quarter. The benefits of the lower prices of coking coal will play out in October, December, most of it.
Okay. And so lastly, if you can just give an idea of what kind of blended price increase in percentage terms or in INR terms was there on a QQ basis. Because of the change in methodology, I'm finding it a bit difficult to calculate. So if you can just add on that, that will be great. Thank you.
On QOQ basis, 6%.
Okay. Thank you very much, sir.
Thank you. We take the next question from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks for the opportunity, sir, and congratulations for a good set of numbers. First question is with respect to the ramp-up plans for Monnet Ispat and FRP. If you can throw some light on that, I mean, what kind of volumes you are targeting and what kind of profitability can we expect from these two assets?
Yeah, so with respect to Monnet, we are awaiting the written order from NCLT, and post that we will be able to comment how soon we can ramp up the capacities. As far as the Italian asset is concerned, as I just said, that we would be looking to restart some of the mills in phases in this quarter, and we would be supplying the billets into Italy from India and other markets and start the mills.
Sir, if I am not mistaken, it's a rail mill, and so what kind of margin, I mean, are you seeing currently over there?
So it's a little early because the rail mills, as you're aware, our plant in Salem is approved. So there is already some consignments which are going to Lucchini for the rail mill. These are for the Italian rail and the Swiss rails which are to be supplied. But the Italian rail contract, again, the tender is coming up for basically quoting again for the next period. So we'll be participating in that, and so therefore the prices in that we won't be able to give you any kind of visibility now, and therefore won't be able to comment on the margin because rail is a tender-based business. As far as bars and wire rods is concerned, we would be aiming to develop the market of bars and specialty steel and part of the wire rods as well in specialty steel. And so we'll have to get our go-to-market strategy in place because the mill hasn't operated for a long while, and therefore the credibility will have to be established again. So we will have to ensure stable sources of supply. We'll have to develop the customers and then restart special grades in bars and wire rods both. But we expect that possibility to be good because Lucchini had a decent brand name in Italy as well as in Europe. So we expect to be able to again get back to the market soon.
Sure, sir. The second question is a bookkeeping question on the coking coal.
Mr. Dixit, I'm so sorry to interrupt. Requesting you to please use the handset mode as you're not audible.
Sure. So the second one is a bookkeeping question. What is the coking coal cost that went into the P&L and the level of acceptances in this quarter?
So we had a coking coal Brent cost of $205, which was similar to what we had in the last quarter, CFR basis. And we expect this to be flattish for this quarter.
And the level of acceptance level?
So acceptances for raw materials is at 1420 million as on June end.
Okay, thank you and good luck, sir.
Thank you. We take the next question from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, so thank you very much. I just wanted to understand that regarding the iron ore cost that we have going forward, do you expect to maintain the same import mix that we have seen recently, or you think that the domestic sourcing should stabilize and hence iron ore cost can potentially reduce from current levels?
As I mentioned earlier, one iron ore availability in Karnataka is improved from 29 million to say 34-35 million. Second, another 3 more mines, our captive mines will be in operation. Then definitely it will ease out. And in my opinion, in future the prices has to be, better now from today.
Sure, sir. Secondly, if I look at the notes to accounts, it seems that there was a 283 crore grant income recognized in this quarter because the process of disbursing incentives is not notified. And for March 2018, this amount was 821 crores. So basically, it implies that roughly 1,100 crores of recognized income is sitting in the books as receivables from the government. So what is the timelines when you think that this notification would be issued? Because the longer it gets delayed, the larger the potential payout, cash payout from the government would have to be.
The government recently has come out with a notification confirming that earlier benefit which was accrued to the industry will continue. So I think in principle government has already confirmed. What you are referring is the modality of taking refund to either an NPV route or to a refund route. So we expect this notification to come shortly. And once that comes, this amount which is crystallized will start getting realized.
Okay, but as of now, this entire amount of, more than 1,000 crores essentially sits as something that the company needs to realize from the government, either a refund or something else, right?
That's right.
Okay, thank you, sir.
Thank you. We take the next question from the line of Ashish Kejriwal from IDFC Securities. Please go ahead.
Yeah, thank you. Sir, is it possible to quantify the blended steel realization on a quarter-on-quarter basis in absolute terms?
So we do not share the realization on an absolute basis, but I think what we have shared is the EBITDA numbers and the quarter-on-quarter impact of price increase also, which was 6%.
Okay. So if I ask that, in our top line, besides steel sales, there are other items like which we have changed in terms of shipping revenue and other things. So what could be that amount which is included in top line?
So as a result of this accounting standard, roughly around 400 crores, which will get realigned to the turnover for the quarter.
This is on shipping one. And besides steel sales also, we have some scrap sales or power sales and trading sales also.
Yeah, so they are more or less at the same levels. What I am referring is the delta change which has happened in the quarter, which is around 400 crores.
Okay. And so secondly, again, this is related to your iron ore sourcing. When you said that, value in use is better by adopting imported iron ore. So is it possible to give a sense of how much we are benefiting by importing iron ore and to what extent we will continue to do, going forward also? Because as of now also we are not taking much of iron ore fines from NMDC. So what's your sense on that, and when can we start lifting material from NMDC the way we used to do earlier?
The lifting from NMDC is our normal lifting, and whatever value in use and the prices of imported and outside the country as well as Odisha, there is a requirement. As per requirement, we import and bring it. And it depends on, what parcels are coming and what prices it is coming and all. But we are lifting full capacity, full quantity which is available from NMDC.
Okay. So in case of pricing, is it better to source from NMDC currently, or is it better to get imported iron ore?
No, first whatever is available in Karnataka, we will take that first. after taking others actually, because there are many small industries are there, they purchase. Whatever balance requirement is there, that we have to source from out of country as well as from Odisha. That is our system we have adopted.
As Dr. Naval also explained, there is a gap between the total availability because the ramp-up in Karnataka is still going on. So there is some quantity which you need to get outside from Karnataka, which is whether it's Odisha, whether it's import, we decide. Since you are anyway getting it from outside the state, outside the country, a better mix in terms of higher quality grade, which gives you value and use advantage, is always beneficial. So therefore, we have been adopting that as a policy. But the mix, as you said, can change a bit depending on how the prices move in the market.
Yeah, so that's what I was trying to look at, that, in value and use, in a sense which if you can give that, we are getting advantage by using more of imported or Odisha rather than NMDC's ore in Karnataka.
Well, it will be difficult to generalize that. It will depend at a particular point of time for where the consignment is coming from, what mix you're having in a particular month. So it will be difficult to put the value and use as a number across to you. But I think the point is we were trying to look at higher Fe, lower alumina.
Right, also to explain.
Higher Fe and lower alumina, which was there in the mix, which was giving us value.
Okay, fair enough. Thank you.
Thank you. Before we take the next question, I would like to remind participants to please limit your question to 2 per participants only. You may come back in the question queue if you have a follow-up. We will take the next question from the line of Dhruv Kansal from CRISIL. Please go ahead.
Yeah, hi, good evening, sir. Thanks for giving me this opportunity. My question is regarding the European Union trade barriers and the impact of it on JSW, given the fact that JSW gets 20 to 25% of its revenue from exports, and India's total exports to Europe is about 30 to 35%. And that too primarily in the flat segment. So how do you see, the impact of the restrictions on the revenues of JSW?
So you would have seen in our performance as well as in the guidance that we had planned to moderate our exports in this year. So you will see that already playing out in quarter one, where our exports ratio in terms of percentage has already gone down to 12%. Last year for the full year, it was 23%. So we are already moderating our exports from the end of last quarter in response to the various trade actions which have been taken. Having said that, I think EU, the safeguard barrier which has come, you will be aware, is basically a quota-based kind of a thing, where the last 3 years average has been taken into account for providing a quota. They have given a quota for 200 days, and during which, if it crosses that quota, then there will be 25% duty levied. The provisional duty will be applicable for 200 days, post which the investigations during this time will take place and a permanent duty will be put in place. However, they have not given it country-wise or company-wise, so maybe we'll have to see how the investigations go and it finally materializes. But I think it is good in the sense that the European safeguard methodology has given a sense of certainty to the market. The uncertainty which was prevailing when the safeguard was not announced has now been removed. A quota-based system has given a comfort to the customers who were importing that their normal imports would continue. So from that perspective, I see this move having provided better stability to the European market. As far as our exports is concerned, just to reiterate, we have already moderated and we will be selectively doing our exports to various countries across the world.
Okay. Thanks a lot, sir.
Thank you. We take the next question from the line of Pallav Agarwal from Antique Stock. Please go ahead.
Yeah, good evening. So I had a question on, on these benefits that we're getting on the GST. So normally these sales tax deferral schemes are for a period of, I guess, 10 to 15 years. So how many years do we have left at Dolvi and, Vijayanagar getting these benefits?
So the pending period for our incentive is on a similar level as what you have mentioned. So different plants are different. So these are around 10 to 15 years period.
Okay, so and so we have plants which would still have a period of 10 years, or some of them would be close to the expiry period right now?
Yeah, some of the plants where we are already getting earlier, so they would be over next 3 to 5 years. But the new expansions which are happening, they will be over about 10 to 15 years.
And also, would we be getting these benefits on export sales, or this is primarily on the sales in the domestic market from these units?
So these are based on the investment and the SGST what we pay. But under GST, wherever there is an input GST and the entity exports, so to that extent of exports, you are entitled for the refund of SGST which is already paid.
Okay. So just one more question on the coke. So so how much of coke are we actually purchasing from the external market?
So it is in Vijayanagar, it is roughly in the vicinity of about 1 million tons, 1 to 1.2 million tons per year. In case of Dolvi, we have just started the Kokugan batteries, the new ones. So I think there the coke purchase from outside would now decline and will be zero.
So this would be from DCPL and Amba River Coke at Dolvi.
Yes.
Okay, sir. Yeah, thank you. That's it from my side.
Thank you. We take the next question from the line of Abhishek Poddar from Kotak Securities. Please go ahead.
Thanks for taking my question, sir. So just one question on Monnet Ispat. As per the reports, it says that, the shareholding of the entity would be close to 75% in the company. Should we assume that the economic stake also will be 75% or the economic stake will be, close to 100%? Hello?
Currently, we are still awaiting the uploading of the judgment of NCLT. So once we see the fine print, we will be able to confirm what are the final changes, if any, and accordingly confirm them.
Sure, sir. So the second question is regarding just to Mr. Acharya. We have seen a sharp correction in the rebar prices in the last 2 to 3 months, while the difference between the flat and rebar has increased a lot. So other than the seasonal factors, do you think it's because of the capacity ramp up by the new players that is also leading to such pressure? And also, between the flats and longs, how are you seeing the demand, and are there any signs of longs demand improving?
Yeah, so I think TMT this time around, if you see, usually in a season like monsoon, the TMT prices are more depressed. But TMT, I think the demand would be good because the infrastructure spend of the government has really gone up. If you look at the various projects, if you look at the metro projects, if you look at the Bharatmala project, if you look at these IKEA mega stores which are coming up, there are 25 stores which are likely to come up. And each store consumes, let's say, 12 to 15,000 tons per store. So you will automatically generate 200 to 50,000 tons of demand, TFT demand just from the IKEA mega stores. You are also looking at the Zuari Bridge, you're looking at the coastal road, the Navi Mumbai airport. All these things, I think, in terms of infrastructure spend, which is panning out, would play out from October. So my sense is that from October onwards, you will see TMT demand picking up, and therefore the possibility of recovery of some of the prices which has been lost in this period is good. So I'm seeing a reasonably decent demand. There is not much of new capacity which has come up from any of the primary mills. The secondary mills also, by and large, are operating at a better level because of the higher margins. And that is why the higher operating capacity, lower demand due to monsoon resulted in the current price change. And that with October onwards, demand picking up, I think will again see some improvement in prices and demand as well.
Okay. So this is the last one regarding the captive iron ore mines that have started production. What was the production in this quarter and how do you see the ramp up from here on?
The two mines which is already in operation is a 0.7 million. So we are going to total mine it and dispatch it. Another three mines which are going to be in operation this financial year, around 3.5 million. And we are hopeful actually to start in next 2 to 3 months' time. And this financial year only will do the full production of that.
And sir, on the costing, how lower would these mines would be compared to the mines that that you're buying from external sources?
Definitely, there will be saving of at least less than 20 to 30%.
Okay, thanks a lot, sir. Thank you.
Thank you. We take the next question from the line of Pranav Tendulkar from Rare Enterprise. Please go ahead.
Hi, thanks a lot for the opportunity. I just wanted to ask, you are seem to shift capacity mix clearly towards foreign assets, and is the trade war that is going in is one of the factors which suggests that the long-term ROC of local plays will be higher than the past, and that is why you are acquiring assets abroad?
So, we have been looking at international assets not only from the time the trade issue started, before that itself. I think that has only got, I would say, accentuated in terms of the fact that it is supported by trade measures. So it is good to have facilities in those countries where these issues have come. So I think we see a good opportunity as far as US and Europe both are concerned. But having said that, I think what you need to see is that the cost of acquisition has been value accretive. So we have acquired these projects at a reasonable cost, and therefore the chances of value accretion in those economies is good, irrespective of whether the trade barriers are in place or not.
Right. So, sir, just a question from my side. What is the cost per ton of coke and iron ore that you incurred this quarter, and what is the outlook for next quarter? Thanks a lot.
So we have been giving the coal numbers, and our blended cost in the last quarter was $205 CFR basis for the coking coal into the coke ovens. As far as iron ore is concerned, we have different brands and different plants. It's difficult to give one number. But if there is any further detail you need, I think Ritesh will be happy to help you.
Okay. Thanks a lot.
The next question is from the line of Bhavin Chera from Enam Holding. Please go ahead.
Good evening, sir. So, in case of the conveyor belt, which you said would start latest by October, how much time it would take to ramp it up to 20 million capacity?
Maximum it will take, say, like 1 month time.
Okay.
The capacity of the conveyor belt is 22 million.
Right.
So immediately we'll move all the material, whatever we are sourcing from that sector. So we are hopefully actually we'll go for 10 to 12 million within 1 month time.
So you are saying in that sector currently you are sourcing 10 to 12 million, so you will be able to move roughly that amount of iron ore on an annual basis on that conveyor?
We have planned actually, it take total material, whatever in that sector is there, but initially 1 month, hopefully in 1 month we'll go for 10 to 12 million.
And the savings would be almost 300 to 400 rupees a ton?
Yes, definitely.
Okay. And so second question would be, what would be the overseas capex figure in current fiscal and next year? Hello? Hello?
The acquisitions have just been completed. So for the Ohio unit, what we are doing right now is we are spending a small amount on getting the electric arc furnace up and running, which would be in the vicinity of about $50 million, which would go into getting the electric arc furnace up and some small spends to the other areas. As far as Lucchini is concerned, I think we have just concluded the transaction yesterday, and we are yet to get into the plant in full detail to understand what spend is required. But as of current, we envisage that we will be starting the mills only. So therefore, we would be spending very small amounts, if any, required to basically refurbish the mills which may have been closed for some time, so that we can restart production. We are not immediately embarking on the capex for the expansion till we put our feet on the ground and understand the dynamics of that market.
Okay, thank you, sir.
Thank you. We take the next question from the line of Prateek Singh from Credit Suisse. Please go ahead.
Hey, congrats for a good set of numbers, sir. So on the iron ore auctions, any new auctions of the mines that are coming up which we might participate in? Also, if you can give me a ballpark mix of your iron ore currently, so how much we buy in Karnataka, how much in Odisha, and how much are the imports?
Regarding auction of the mines, 5 mines we got earlier out of 7 mines which has come for auction. And again, now there are another 7 to 8 mines are going to be in auction in next 3 to 6 months' time.
Their capacity would be, sir, for these 7 to 8 mines?
Definitely all the 7 to 8 mines, roughly around 10 million. 10 million yearly basis production.
Okay, and regarding the import, the iron ore mix, sir?
As I mentioned earlier, we are bringing around 3 to 4 million. Whatever first available in Karnataka, we source it. And balance we source from Odisha as well as out of country.
Okay, so regarding sourcing from out of country, given the widening discount of low-grade iron ore versus the high-grade, so globally, is it something that you are also looking at to maybe get low-grade iron ore? Is it something which you think would be viable?
So when you get material from a distance, you'll have to look at the entire product basket, not only the Fe. You'll have to look at the alumina, you'll have to look at the silica, and then see what makes sense. But I think we would, as we said, that we are sourcing value accretive material, which would give us strength in terms of value and use.
Understood, sir. That's all from my side.
Thank you. We take the next question from the line of Jimny from Amandi Asset Management. Please go ahead.
Hi. May I ask about your funding plan, please? I remember that JSW was trying to come into the market last time, and the pricing wasn't right. So I'm just wondering when would JSW consider coming again?
So as a policy, we continue to look at an international bond market as a means to diversify our borrowing. As you are aware that currently the markets due to trade wars and the Fed hike is still not in a stabilized mode. We are watching the markets and secondary hits very carefully. As and when we see an opportunity, we will continue to access this market because ours is not one-off event, but we will continue to access international bond market as a means to diversify our borrowing base.
Thank you.
Thank you. We take the next question from the line of Bhaskar Basu from Jefferies. Please go ahead.
Good evening. Just a couple of questions. Firstly, if you could give some color around how you see Monnet ramping up, and what kind of volumes are they doing right now, and how do you see that ramping up over the next few quarters or next 2 years?
So Monnet, as we just mentioned, that Monnet the written order from NCLT is awaited. So once we receive that, we'll be able to study and then revert to you.
Okay. Secondly, on this, a clarification on the conveyor issue. So you mentioned 10 to 12 million tons initially. Is that what you expect once the conveyor ramps up, or you think more volumes will be shipped after the conveyor ramps up?
The capacity of conveyor belt is 20 million.
Right.
And initially, you have to divert all these routes and all, and then we are thinking around 10 to 12 million in first 1 month we'll do it. And then gradually we'll divert all the supplies which is coming directly to the plant through the conveyor belt.
So eventually, say 1 year down, how much do you...
We are building some downhill conveyor also directly mines to this conveyor belt. That is also the construction now. So once all downhill conveyor will be ready, then this will be loaded to 20 million to 22 million.
Okay, got it.
1 year time.
Yeah, so next year I think this 20 million, maybe not, but annualized basis will play out.
Okay. One more on the Ohio unit. So basically, I think my understanding was one of the main issues there was with the electricity tariff at that plant, and that was being renegotiated. So any update on that?
No, there in Ohio, the electricity tariffs or the support being provided by the locals have been discussed with the past owners as well. I think there are some concessional tariffs which are being discussed on electricity. Those are, under finalization. So once we have some more details, we'll be able to share that with you. But yes, concessional, some support on the concessional electricity is under discussion.
Okay. And just my final question on the Italy unit. Just a confusion there. My understanding it's all downstream units, but somewhere you mentioned that it's primary, part of that 8 million ton which you were talking about. So,
yeah, so it's a 1.3 million ton rolling mills, which is without a hot band there. So, billets will be sourced from India and other markets, and we would be operating the mills. As far as the primary, which I mentioned, was from a medium-term perspective, that we would look at the possibility of putting up a hot strip mill on a medium-term perspective, provided it makes economic sense. So we would be studying the market, we would be studying the economics in that area, and then take a decision. But that's a medium-term view.
And when you say hot strip mill, you basically starting from steel production, the whole rate.
Correct. That will be a project which will be integrated for 3 million tons. So we'll look at the possibility, we'll evaluate it, and then take a call.
Okay. Thank you. That's all from my side.
Thank you. We take the next question from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. So, first clarification is that post the commissioning of the conveyor, the cost of procurement from local producers will go down from 500 rupees to 100 rupees per ton. Is the understanding right?
So, this is basically freight is in our account. So, this is
that's the freight, the freight, yes.
Transportation
cost borne by us only as in today. So this is our saving only.
Yeah, so that will go down from 500 rupees to 100 rupees per ton, right?
Less than 100 rupees.
Less than 100 rupees per ton, okay. And just to understand on the import procurement mix, so the last quarter import procurement that you have done, it would have been largely 57, 58 grade Fe, right? Is the understanding right?
No, it's not correct. There is so many different things in that. Not straightway this is 57, 58. There's very high LOI, so equivalent it is 63%.
Okay, and what would be the average alumina grade? 2.5?
Less than 2.
Less than 2. Okay. Okay, and is there a penalty for silica also which you are trying to get from the local producers, or that's not yet started?
They're all nitty-gritty, you know.
Yeah,
there are so many
sources,
things.
so it will be very difficult because it will be source to source, it will differ.
Before the ban on from the Supreme Court, all these things were applicable of penalty on silica, alumina and Fe. But now, after this Supreme Court ban in last 7, 8 years, things are different actually.
Okay.
Nobody's
Got it. Thanks. That's all from my side.
Thank you. Next question is from the line of Rajesh L. from HSBC. Please go ahead.
Yeah, thanks for the opportunity. So I basically wanted to understand our strategy or thoughts that have gone behind the overseas acquisition, and how should we look into it in the future. So you have said 8 to 10 million ton, but can this number increase further?
No, I think I mentioned that we have been looking at facilities internationally wherever the asset makes economic sense, where the capital cost is value accretive. And we are looking at markets where the growth in the domestic market is reasonably good, and we are taking calls in those markets as of now. So that's why what you are seeing in terms of the investment in U.S. is basically in a market which is growing reasonably well now, and is also supported by the recent trade measures. But in spite of that, I think it's a market which consumes 100 million tons of steel. The second advantage in U.S. will be the melted and manufactured steel in America, which has certain advantages because you will be able to bid for projects, you will be able to participate and sell to customers who have projects for melt and manufactured in America steel. So the idea is to continue because we are not able to sell anything from here to America because of anti-dumping. So we will have one facility there in America to basically service customers who we have earlier been servicing. Similarly in Europe, I think the idea was that it's good to have assets in the international market where you are able to bring in value. And as long as the capital cost of acquisition is competitive, it will make sense to do that. So that's what we have done in Lucchini as well. And we plan to basically, as I said, restart the rolling mills and make specialty products to start with.
So just to make myself more clear, so if there is economic sense going forward, even after these acquisitions, we'll keep on doing these acquisitions? Is that the thought?
So we said 8 million tons is our visibility for possibility in these two locations, 4 million in US and 4 million in Italy on the medium term. Any kind of other acquisitions, if it comes, so it could be between 8 to 10 million is what the visibility we see as of now.
Okay, so max we can go to 10 million as of now.
We are not seeing, we don't have any assets on our books right now which is giving us any different visibility.
Understood. That's it from my side, sir.
Thank you. Next question is from the line of Sanjay Jain from Motilal Oswal. Please go ahead.
Yes, sir. I mean, we've been talking value in use and we're seeing iron cost has gone up, coking coal cost is same. My question is, if you take all these factors into account, I mean, I'm not going in detail, but would you say that your raw material cost on a sequential quarter basis has gone up, or it's almost the same if you account that benefit you would have arrived from lower consumption of coke or better productivity of furnace?
Just hold on for 1 second, we're just checking. Yeah, so the cost on QOQ basis has gone up by about 700 to 800 rupees per ton.
of steel, raw material cost per ton of steel.
Per ton of steel, correct.
Correct. Okay. Second question on our expansion projects. I mean, we are expanding in Vijayanagar and Dolvi, both places, and there was a furnace rebuild in Vijayanagar. So are we going to see some volume boost from these Vijayanagar furnace in FY20, or these benefits we should only expect in FY21 and 22?
One furnace, the BF3, we are going to take for shutdown for around say 100 days, and that time we will change the bigger shell, actually higher capacity, more than, we add another 1 million in that. So that is going to happen in 2019 and 20. Financial year 19.
So volume boost we should only expect in FY20, 2021.
Yeah, 1920. 90, yeah.
Yeah, so it will basically, the full annual playout will happen in the year 21. Part of the increase may come in H2 of 2019-20.
Yeah, thank you very much. Sir, you have any closing comments? And you can close the call.
I think we would basically just like to reiterate that JSW Steel has had a good quarter in quarter one, and the numbers with respect to both production and sales have been good. In terms of the guidance which we had given, in terms of volume, we see that we would be more or less on track. Usually in the first quarter, seasonally, there is always a slightly lesser run rate, and it picks up as we go into the H2. So I think we would stand to our guidance for this year. So thank you very much, and that's the comment from our side. And if there is any further query, the investor team would be happy to address that. Thank you very much.